Hey, good evening. This is October 18, 2023. Just thought I'd share a little something I've been playing with a lot with lately. And, I've definitely been looking at 0 day to expiration trading, but because I started off as a day trader, but couldn't figure out a way to really make it work with a 0 day to expiration kind of trade. So last few months been very profitable doing this strategy, and I'd like to share this with you and get some input from anybody that's in the 0 day to expiration thought process or trading scheme. All right, so first of all, what I found over time is using internals. This is going a little bit outside of 0 day to expiration, but using the internals, market internals, is huge. And I kind of stumbled up on this when I was day trading and I started looking at ranges, and that there are ranges that the market adheres to. So the volume difference indicator, this guy right here, is really interesting because usually it tells you the direction of the market. Like, are most stocks closing lower, most stocks closing higher? And it's looking at the volume of the upgoing stocks compared to those of the downgoing stocks. That is a really interesting indicator because it's highly correlated to the what the market is doing. So let me pull up the VOLD, VOLD, and let's go to the just time-based chart there for a second. And interestingly, this is something that I don't think many people appreciate it. So what we're seeing here is, every hour on the 1 hour chart, every hour that the volume difference is negative, meaning more volume is going into downgoing stocks versus upgoing stocks, you're getting a red print. Okay, every hour it does that. And typically, most days, you can see it's unidirectional, right? So this day was an up day, this day was an up day, this day was a down day, this day was a down day. This day was a reversal day, but most of the time, as you can see, once the market gets going in any direction, once that direction is established, you rarely have a mixed picture. Okay. Now let me bring over just some, what happened today. Now, what you can do is just kind of look at that on your regular chart. All right, so what happens today? And this is a 30-minute chart, which are typical indicators. All right, and you can see how well this graph correlates with this one. Okay. Let's go to today, and there we are. So here we are at 9 open. We got a big red candle. You're looking at over here. You got a huge red down candle. Another red candle, another red candle, another red candle, another red candle, another red. So it's very correlated to this. And you can use this to give you a sense of direction, right? Like that's what the market is doing. It's going down. If you're a swing trader and you're looking at this first, right, and you're trying to look at this graph, the time-based graph, this one on the right, and you're trying to find a trade, you're looking at these ranges, you're saying, oh, okay, we're going down. You wait for a pullback, back, and you are in the trade going short, right? You would not, let's say you're right here and you see this big green spike. Okay, now this is the fake out. This is the move that most people get faked out on, because they're going to look at that green spike and they're going to say, oh, this market is reversing now, right? No. This is the first step. You look at the flow. Second step is, okay, if this is a spike, it's most likely going to reverse because the entire market is going down. So when you see that, your first instinct is, oh, market is reversing. Let me go long. But instead of doing that, if you had the VOLD indicator on, you would see that the market is going down, and this is most likely a temporary pullback. All right, and maybe you wait a little bit, see a little indication of sell-off, and you would take this trade going down. Okay, so that's the idea for a swing trader that's trading on a time-based chart. Okay, now when I started using this with my time-based chart, I noticed a big difference in the overall success rate of the trades and the how long I could stay in the trade, because I could stay in as long as I'm looking at the VOLD. I'm trying to ride that entire move the entire day. So I was staying longer. Now, the other thing that, as a swing trader, that's great. But as an option trader, how do we apply that idea to zero data expiration? That's why you're here. That's what I'm going to tell you. All right, so let's do a modification. Instead of putting this as a 5-minute chart, we're going to make this a tick-based chart. Tick-based chart. We're going to give this 100,000 ticks. Okay, and this is a really fascinating idea. I'm going to remove the studies. Keep this thing very simple. All right, now at 9, this is what I did today. So at 9, I saw that the VOLD was going down, volume was going down. Step 1, you're always referring back to the overall market flow. Step 2, wait for a range to form. Okay, these ranges are commitments, like big time commitments. You have 100,000 trades that are going on, when this bar prints a green, a red, or a green. All right. So at 10:10, this was my first trade. At 10:10, market was going down, and I had this range in play. All right. And I looked at, once that range was in play, I'm looking at the high, I'm looking at the low. The high of this range is 4393. All right. At that moment in time, your assumption should be this is going to continue downward. 2 reasons. The VOLD is going down, volume's going down. I look at all the other indexes. The ES, the YM was going down, the Qs were going down, and I look at the major players in the S&P like Tesla, big volume, NASDAQ, the NVIDIA was looking at that as well, because typically those correlate to the market. Most volume is going into about the top five stocks. So I typically sort that list by volume, and I'm seeing if that's correlating to what the VOLD is telling me. And then the final step is to look at this range, and once that range is in, that first 100,000 trades is in, that's a commitment, and that's what I want to get behind. Okay, and this is how we do it at 0 day expiration. So at that moment in time, 4393 was the top of the range. That was the top of the range. And my assumption is volume is not going to just suddenly reverse and go through that. It's most likely they're going to stay in this range, go a little bit lower, or even go even further. But it's not going to go through 4393. That is resistance. Okay. And right at that moment, I'm going into the option chain. And remember, our number was 4393. All right, let's look at ES. Okay, and so 4393 at that point in time was around 0. It was like around in here, like 30 delta. Okay, so see now this expiration's almost over with, but it was at 30 or 45 delta, somewhere in there, and I sold that. And I sold a vertical spread and just let the market do its thing. It went down, this went worthless, and then right when it gets around 5 to 10 delta, you take it off and you rinse and repeat. All right. So you're going like right now. Let's look back at the chart. That was the first trade. All right. So, and then 4366 came around. This range happened in the afternoon. Market was still going down. VOLD was still going down at that point. Right? VOLD was still negative. Didn't reverse. And I had this range intact. So this one here. In the afternoon. So that would have put us at 4366, all right, as a resistance level. 4366. Remember, the thinking is the market is going down. I'm looking at the indexes. I'm looking at all the indexes. I'm looking at the VOLD, and I'm looking at the major stocks in the S&P. Typically, I have a volume. I'm sorting this by volume. Let's do that now. Volume. Can add that. There we go. All right, so let's add that, and then we're going to sort that. And you can see it's Tesla, it's American Airlines, Nvidia, Apple, and all these were moving down on high volume. So I'm looking at that as well. All right, then when the market gives me a print, I'm like, hey, that's a pretty big commitment. That's 100,000 trades. Remember, we have this tick chart on 100,000. All right, and then so now I have a resistance level of 4366. So at that point, I'm going into the 0 data expiration option chain, and I'm looking to see where 4366 is at that moment in time. All right, so 4366 on the call side. See, I actually got 4370 off. So that call spread, see, now is at 2 delta. But when I put it on, it was like, 30 delta, 30, 40 delta, somewhere in there. So it was, a 1-to-1 trade. Now, if we look at that now and see how that looks, it's reached 100%. So reached 100% max profit. And, I was risking about $500 here. If it hit above 4370, if the market came back above this level and closed above here, 4366, then, I would obviously exit the trade with a loss. But it's the 1-to-1. that I like to go for. So I like to go for anything that is 30 delta, 40 delta. And so here's the magic of this. And I don't know if you guys, I don't know if you guys are hip to this idea, but you know, some people say, oh, it's only 1-to-1, but here's what's happening. You're doing a lot of trades with a high hit rate, like, you know, 8 out of 10 winners, not 7 out of 10 are winners. And you're doing that with the same risk. So you're doing that with you know, risking $100 to make $100. So over time, your risk to reward is $100 divided by the profit you've had over time, right? So you're looking at, like in bonds, I've been doing this idea. And if you look at my, you know, this is sim trading, by the way. I don't like putting my real account out there, so I'm gonna just tell you this is sim trading. ZB/ZB. We've been doing the same idea with /ZB, and at any point in time, I'm risking $1,000, which is like 1% of this entire account, right? On the sim trader account, it's about 1%. So I'm risking 1. And every time this gets to be around 60-70% max profit, you take it off, you rinse and repeat. So over the last month, okay, this was the profit here, 8,593 doing this game. And I've only risked 1,000 at a time. So that's huge. It's almost 1,000% return. So that's the beauty of rolling your positions and, you know, not only rolling them, but also managing the risk. Don't keep going up just because you made money. You keep the risk small and consistently the same, so that when your win rate gets high, your P&L, your return on risk, gets exponential almost here. So I hope this helped. It's a lot. I know it's a lot. Go back and check it out. Tell me what you think. 0-day expiration strategy. And the reason why I came upon this is because, you know, I was doing our condors with 0-day to expiration. I just found that they got blown out a lot. And, you know, you're going out 10 delta, and, you know, that's just too far out. I mean, and if something happens, you're like, you know, you're risking 9 to make 1, or risking 7 to make 1. In this strategy, you're usually risking 1 to make 1 or more. You're risking 1 unit to make 2 if you can get a 40 delta off. So please let me know what you think, especially if you are doing 0-day to expiration already. But using the VOLD in combination with a tick chart, man, that's really been a game changer here, guys. Really been game changer. Because see, on the tick chart, you're not looking at time. Your chart is not dependent on time. It's dependent on commitment. So whoever's in control of the game, whether it's bulls or bears, you are getting behind that team. You're getting behind that flow. Like today, it was all the bears in control. So we got behind the bears and pulled off 2 winning trades, 1-to-1, same risk in one day. And this is what the flow is. So let me know what you think. Take care.